All right. Good morning, everybody. The replays for this morning briefing go to my YouTube page, which I am going to begin developing throughout next year. I really appreciate it if you can help me out. Go over there, like and subscribe. Help me grow that channel out so we can get the word out to more people. Get this morning briefing to those that can take advantage of it. We've got a situation today where we're going to be messing with the Fed's dual mandate, jobs and inflation data both today. It is likely that we don't see any change to the projections for the new year, the rate cycle that's been projected, but you can always go to FedWatch. This is the CME Group FedWatch page. Just type in FedWatch. You should be able to find it. It's free. You don't need an account. Once you go here, just scroll down and you can see when the FOMC meetings are projected to be. And then you can see what the market is pricing in. Are they pricing in a rate hike, a rate cut, a pause? The lack of forward guidance has continued to frustrate a lot of traders. I hear from a lot of people who, they buy and hold kind of traders. Maybe investors would be another name for them. They're not necessarily day trading. They're, living a life where they're not trading every day. And they've continued to express how frustrating this market is. And this goes to the heart of your troubles. When we're in a regime where the Fed is on autopilot and they say something like, yeah, over the next 6 FOMCs, we're going to raise or cut or whatever they're going to do. When we have that forward guidance from the Fed, we are in a completely different market environment. When we don't have that, and every meeting is a toss up, and they say, well, we'll look at the data, we'll let you know when we get there, maybe we'll do this and maybe we'll do that, then the market doesn't have that forward guidance. And we get what we saw through October, November, and into December. They price in a cut, then they unwind it, then they price it back in again, and we get those shenanigans with the market moving up and then falling back down and moving back up again. It's a big mess. So if you're struggling with your longer term buy and hold accounts, I get it. I understand completely, but you have to get that you can't do the same thing all the time, right? That it doesn't work that way. And that, at the end of the day, ETFs, the sector ETFs, and the indexes are your go to. Mutual funds of things, like large cap, medium cap, small cap, those kind of simplistic mutual fund type plays just keep you in the market. They're not going to zero, and or just go to cash and hang out. I don't like to go to cash and hang out. I think that's the worst answer available, but it would be better than taking losses. So, just realize what environment we're in and how much it affects everything else. And this is one of the biggest ones. There's a really good book written by Gerald Appel. It's an old book, but Gerald Appel is the guy attributed with developing the MACD. I believe it's the MACD. Something like that, right? You can imagine he's a guy who's been around for a long time if he's got that sort of attribution. And in that book, he laid it out really nice, right? Talking about the Fed and what they're doing. And then just some simple things like, is the S&P above the 50 and the 200? And is the Fed on autopilot? If that's the situation, then it's growth over value. And it's, it's just a whole simple process. And if you just want that book, let me know. It's a free PDF I found on the internet. You don't have to buy the book. Of course, if the book makes you money, then you should spend some of that money and buy the book and support the author. So today we're going to get some of that data. We're going to get some jobs data. We're going to get some unemployment data that still have that missing gap, and then the inflation data. NASDAQ up 0.75%. MU had earnings yesterday, and it was being heavily watched as a tell on the whole AI thing. We're getting into this period where every single company that has any tangent connection to AI is being watched for any signal or tell that the house of cards is coming down. I was going to say something else, but changed my mind on that. It almost seems like a pyramid scheme, right? The way that these companies are cycling everything around. And are they going to let Oracle into this little pyramid scheme where they can start cycling money through Oracle and back again? Because it seems like Oracle's out there on its own. But, bring them into the fold, right? And let them participate in the same shenanigans. But everything went good. MU didn't crash and burn. So the AI theme is still alive. NASDAQ up 0.75%. The S&P 0.5%. That discrepancy is not too bad, but look for one to catch up or the other to catch down. Japan is still on focus for their rate hike. At this point, it seems to be a foregone conclusion, but they might not hike. They might not. I doubt it. I really think they're going to hike. I think everybody thinks they're going to hike, but we'll see how that goes. Small caps up the least. Well, I take that back. I guess we got the Dow down there dragging its feet. In the last quarter, we've seen small caps leading the way a lot in the overnight. And this is not one of those mornings. Really want to see how they close this week. So CPI and jobless claims. And you can see they're still running the asterisks. Limited October and full November results will be combined into one report. We got some auctions today, mostly in the front end. So this will tie back to the CME Fed Watch. Keep your eye on those two throughout the day today. You can use something like the IRX if you're just looking at the front end. It summarizes nicely. All right. BOE cut. It's not a surprise. That was their signal. We got executive orders coming out at 1:30. And then Defense Authorization Act at 6 o'clock. That'll be too late for us. Yeah, they're running at a 90% odds of hiking for the Bank of Japan. And there is still carry trade unwind risk. Kind of a big deal. So Oracle's got a spending problem. or maybe it's a debt problem. I guess it just depends on which way you want to look at that coin. Conflicting resolve and narrative, huh? Botgamma came out with the founder's note for the morning early. I need to submit a picture, which I didn't do it yet. The put wall has rolled up. You can see when I get it posted that the levels are changed now. The put wall's location is 60, no, excuse me. Yeah, I said there, right? 6,700 is where the put wall is. So the put wall will be right here. They rolled that up. On the one hand, it's only one day. So it needs to be there for more than one day before we start making some assumptions based on its new location. One day being rolled up, not a big deal. But if that is going to be the new location as we get through OPEX and into next week, then it's considered to be a little bit bullish, right? You bring the put wall up so that you can push off of it for a move higher. On the other hand, if you're looking to break the put wall, bringing it closer to you is a nice way to do that. That's because if the put wall is too far away, if, for an example, it was still all the way down here, and then we fell a long way to get to that put wall, we would pretty much be exhausted and we'd have a hard time getting through it. If you tighten the put wall up and we fall into it, then it's easier to get through it because we haven't run as far first. So then we can get, a little bounce and then break. Need to see it play out first, and it's only been there for one day, so we don't want to read too much into it yet. You can see that we found the 10-week. If we were to push this forward, there's the 10-week. So that's our basing point right now. It's a ugly little head and shoulders inverse. We don't use head and shoulders. Head and shoulders are the joke of all the price patterns. So never want to trust a head and shoulders pattern. This also is starting to look a bit like a failed flag, even if it's a really ugly version of it. And it's only a 1-day failed flag. I like it better when it's a 3, 4, 5-day failed flag. And we are on the midpoint of this measure. Generally speaking, we could still use the other measure. We got completely under it yesterday if we use this measure. And that measure is still valid. There's nothing wrong with it. But you can also use this other measure. Put them both on there and it creates a little channel or a zone that price can hang out at. If we get completely under this, then we're going down to 66. And then we'll see if we can get a 111 or a 1236 underneath that, which should put us somewhere around 65.5 because we're still running 50s. Otherwise, if this holds, we're going to start working our way back up and questioning whether or not we can get a higher high or an equal high. We need to get that. If we bounce here and start to come up, but we can't even match this high, then it's likely we're going to be bouncing here just to get some momentum to break it. All right, first we bounce, then we break. So we don't know yet. And we can't count this as a high or low. Not yet. Today's not done with. Sure, it's green now, but by the end of the day, this could be a red bar, and that would just be a continuation to the downside, right? So this is not a high or low yet. If we close green and higher than the midpoint of the previous day, maybe we could count that as a high or low. We'd have to look at it tomorrow and make that call tomorrow. We are firmly underneath the 50 now. Kind of a big deal. When we're underneath the 50, the size of the days can get a lot bigger, right? This is to the ADR, the average daily range, gets bigger underneath the 50. We're also underneath the zero gamma. Now we're really close to zero gamma, right? Really close, but we are underneath it. So we're in a negative gamma environment. The thing is, when we're right on the line like this and we're really close, we can't lean into that bias about how dealers will perform. Generically speaking, when we're under the zero line, dealers will sell into selling and they'll buy into buying. So they exacerbate the move. Whichever direction we're going, they'll push it even harder and even farther. If we was above the zero gamma line, they would do the opposite of that. They would sell into strength and buy into weakness, and it stops us from making big expansive days. That's why bullish market environments don't have as big of a candle consistently as bearish markets do, right? Bear markets generally have bigger bars. But we're right there on the line. We're really close to it. So I wouldn't bank on seeing that sort of regime at this point. Plus, Volland argues that this paradigm that I was just describing is not a constant thing. Dealers are not always in that sort of mode where they choose between one of those two. There are other paradigms, is the word that Volland uses, and that traders need to gauge and assess whether we are in that sort of regime or in one of the others. They got a really good white paper on it if you haven't come across it yet. And I think they've done a couple of YouTube videos on it. So any move to the upside is going to have to fight through all of these moving averages. And they are significant, to say the least. Overnight volume still really good. They did not sit out in front of this big data that's coming at us today, which perhaps is a little bit of a concern. I don't like it when the market gets too cocky because they've been wrong before. We know they'll be wrong again. And when they get cocky like that and then they get caught off sides, that's when we see some really big moves. This is the ADR today. We got to ignore the market maker move because we're in OPEX triple witching and the whole week is shot. We can't use that market maker move. If you haven't rolled your futures contracts yet, please roll. There's no reason to be on the old contract at this point. The volume is squarely on the new contract. You should be using March at this point. If you're not, roll it. We are underneath the weekly pivot. That puts us in a bearish backdrop. Today's floor pivot is lower than yesterday. That's bearish. Price opened underneath it. That's also bearish, but we haven't hit it yet. So that implies we're going to continue to go up until we do hit it. So far, it's a missed daily pivot because we haven't hit it. And if we go all day without hitting it, then we can count it as a missed daily pivot. But we cannot count that right now. We are in the channel, and the channel is wide. Wide channels imply if we break out, the breakout won't stick and we'll come back in again. And so far, that's holding true. We did break out and we came back in again. This is what we would need to break out of. To the downside or to the upside, wouldn't matter. That's what we would need to break out of. So you can see we broke out on the bottom. We came back in. We would have to run all the way through this and then out the top. And this wide channel says if we do that, we're still likely to come back in again. Just keep in mind that this channel doesn't make price do anything. It's just giving us a read on what to expect if we did break out today. We got an R line basically on the weekly pivot. So that weekly pivot is already going to be considered a resistance, and the R line sitting there would now also be counted as resistance. And then we have yesterday's floor pivot, which we would carry forward into today, and I would consider that to be resistance. So there's a lot of structure. It's also a roundy, right? 6850, big round number. Options level is what I should have called it, not a roundy. It's an options level. So that's a significant level. Just getting there, if we get close, it'll start to act like a magnet. We'll draw into it. And then we're likely to reject off of it at least the first time. So that'd be a good one touch play or first touch play. If we can get through it, get completely out of the weekly channel for an expectation to check yesterday's high. If we just get into the channel and we get above the floor pivot, I would not target yesterday's high. I would target the top of the channel first. If we get out of that, then target yesterday's high. The reading on this floor pivot is to the downside, by the way. It's still saying it's more likely that we go down from here than up from here. Now, this pivot indicator doesn't make price move, right? It doesn't make us go up or down. It doesn't make us go anywhere. So it's saying that it's easier to go down than up because this green line is farther away, that's S1, than this red line, which is R1. You can see how the R1 box is much smaller than the S1 box, right? See how much bigger that is. So it's saying the down move is more likely than the up move, but it's just a math formula. It's not looking at anything. It's not looking at options flow, the dollar, the yields, the bonds, what the Bank of Japan is doing, headline news. It's not looking at anything except the math of yesterday, the open, high, low, and close. So yeah, it gives us a little insight. Just keep in mind that it doesn't make us do anything. All right, at this point, we don't have a clear distribution. You know, in these previous weeks, we had the classic D shape, or we had these double distribution shapes. We even had this bastard version back here. But at this point, we've got a very solid structure within the value area. And then we've got this speed bump down here. Now it's 20 points wide, so it's closer to 30, really. It's a great zone, and it could build out to be a whole new distribution. But we already came out of it, right? In this sort of failed flag play that I love. It's actually like a failed pennant. I love that pattern. I just, it's one of my more favorite ones. Get through the mid and make it back to the top. If we reject the mid, then we're going to recheck the bottom, and then we open the door to the downside. But it's got to play out, right? And we're already above the 786, so we got to aim for the half at this point. Ten-day, 30-minute volume profile and TPO. The TPO and the volume profile have lined up with the point of control. Things are looking really good. The TPO is much cleaner at this point than the volume profile. The clean profile that we had, you know, it lasted for a couple days. It was the best we've seen all year. And well, now the house is dirty again. The way it goes. We're putting in some structure along the low, but nothing that could move the point of control at any time. So that thing shouldn't move for at least another week. No new VPOC from yesterday. We ran right through it all night. The one that we had from Monday, we left on through Tuesday. You can see how we were still interacting with it Wednesday. It wasn't a VPOC at this point. It was just a POC. And I'm going to continue to leave this on. This is not a VPOC at this point, right? It's just a point of control from back here on Monday. And it still has relevance as far as I'm concerned because we haven't made it through that level yet. 6880 is an old school cog line, by the way, not 6880, but 80s. 80s are an old school cog line. So you always want to pay attention to an 80 level. Having that point of control there and seeing the significance of it and knowing that we haven't been able to get above it and keep it yet says we need to keep that on our radar. I'm not taking it off at this point. They're coming in pretty hard across the top. So you could consider this, that we ran into a bunch of sellers, but it doesn't mean that they are from today. It could still be a part of this distribution from last night, from yesterday, right? Could be all of that just being carried forward. That's why you want to keep your eye on high volume nodes, right? If that was a significant playing field yesterday and we get back up into it today, it could again become a significant playing field. It's as simple as that. It doesn't mean that we're going to see activity there, but you can watch the clock, keep your eye on the dome, see the orders coming through the queues, the CD, the tape, and watch to see what price does as it gets into that level. So tape speed pick up, do orders start piling in, we get pulling and stacking, right? That's kind of the basis of the whole thing. So it doesn't hurt to know where the speed bumps are. If we just use last week's range, you can see we're outside of the box. Now we could go in and draw it out by hand and, finalize this week's range. But it's been a significant move to the downside. We're looking to get that turned around. We got to hold above 6,800 to begin challenging everything that's over our head. 6811 COG, 6832, 6850. All of the moving averages except for the 200 are over our head. We got to fight through that as well. Then last week's close and last week's high, then we can push above that 7,000 level. We're still under the 10-day, not as deep as we were, but we're still under there. Now I've got an imaginary collar that I think of every time I look at this. It's a 0.5% above and below and 1% above and below. And I've thought about coding that into this. The problem is you can see how it glows when I put my mouse on it. Well, if you put a cloud indicator on Thinkorswim and then your mouse touches that cloud, it really pops, right? It's really bright. It's annoying as heck. And I just don't want to deal with it. So I don't put the cloud on there. I just know that there's a collar at the half and a collar at the 1%. We got below the 1% yesterday, but we came back inside of it. We want to stay inside of it. We do not want to get outside of that collar and close outside of it and continue to push, right? Like we were doing back here. If we do, it heightens the possibility of a mean reversion, but only after a more significant drop, right? Like this. It's where it gets really ugly, really deep. That, of course, was April. It was bad news, bad time. Markets were freaking out around the world. And so, it got pretty ugly. But it can get 2.5% to 3%. and then we turn around, right? And that didn't even give us a good market backdrop for a bounce. That was just a move down into a new contract and into FOMC and a little bump up before another leg down. So we need to stay above that 1%, that minus 1%. We start getting underneath that and things start to get ugly. Looking at what's down today, the Mag 7 down volume is down. Yep, that's a double negative. Over a 5-day period, that was down more than 21% in a 5-day period. We kind of needed a bounce at that point. You know, I said that wrong. It was up. It was up more than 21%. So it needs a pullback, right? It's been crazy bullish. The down volume has been crazy bullish. You see a bullish momentum. So it needed it. But that's what the question is. Is this just a pullback in the down volume? Or are we finally turning things around? GDX also down this morning. So gold miners, they're both down. And really that's it, because the rest of these aren't down enough. Flip it over, look at the other side. What's up this morning? Bitcoin, chips, China. Generic tech, China again. Uranium, emerging markets, which is China again. Mag 7, China again. Expanded tech. Now, when you see that one, expanded tech, you got to watch it, because you'll get these little algo prints. I'm not even sure you can see that in the live stream. There's one here and there's one here. And that's not saying much, right? Those little algo prints don't matter at all. They're completely worthless. We need to see some candles in the pre-market, something that's actually filling out, right? Otherwise, you can get those algo prints, say like back here, they were up, right? There was algo prints, and then it just, they don't mean anything. So it is up, but it needs to show us that it's real. That is a really big head and shoulders. We have the sectors today for a rally, but just like yesterday, it doesn't mean we're going to get one, right? It just means we've got the sectors for a rally. I'm surprised really that we have anything in front of jobs data and inflation data. I would have thought that we would sit out and wait, but the market has been sitting out and waiting, and it looks like it just got tired of waiting, which isn't a surprise. But what's leading this morning is pot stocks, and then nat gas, and then chips and Bitcoin and cloud and tech and China. Well, Bitcoin, chips, and tech, that's it right there. That's our bread and butter. That's all we need for a rally. Bring China into it just makes it better, right? That's just perfect. And then we got the mags, and that's all we need for a rally. So having all of those is great, but it doesn't mean we're going to get our rally. Those could turn around and just fall flat on their face when the news comes out. Then the news could literally just change the entire backdrop and send us completely negative. And there's no way to anticipate what the news is going to be or if the market's even going to like it. Jay, it's a really good question. I don't know if this is the place to answer it, but the 0-day traders do have an impact on the daily move it, but not at this point in the day. One, we can't see anything that they've traded yet because they haven't traded anything more than the options on the futures. But two, their impact would come after 11 because it takes time for them to, really start to wind up and figure out what they want to do and start piling it in. And you should see those flows. There's, like black box stocks, cheddar flow, those kind of places. Certainly Volland and Spot Gamma, to be able to see their impact piling up. So they can influence a daily move on a day-to-day basis. And a lot of times we see that when it tries to turn off the bottom and they rise up into the 786, but they're not able to get through the 786, and then they continue to fall. And that's because 0-day tried to push, right? And that's what they don't even know if it's going to work, right? They give it a shot and see if they can get the push. And if it doesn't work, then they flip it over and hammer it to the downside. Same thing with an upside move. If they decide they want to try to roll that over and go the other direction, if it doesn't work, they'll at least have tried. This isn't a good example of that trial. It would be smaller than this. This went a lot farther back than I was thinking for an example, but I'm going to snap on that one. That was a halfback, right? They at least gave it a good run to try to bring it back up, but they couldn't get back through the half and ended up fading it back out again. So that is a 0-day player's move. You'll see that in Spot Gamma and Volland when they start driving this up for a push. The flows will come in, the tape speed would pick up, right? And start to see the imbalance. So yeah, they can have some influence. But it's not as the RTH starts, right? The 0-day player's influence won't kick in until later in the day. They're not going to be the influence first thing in the morning. Plus, like we were talking about yesterday, from 9:30 to 10, the options data is trash. The options prices are trash. And the big money that plays 0-day, and there is big money that plays 0-day. Even the Goldman, JP Morgan, the firms, those guys are playing 0-days. They're smart enough not to play in that first 30 minutes when it comes to options because they know better. That the price is trash, and it is not the time to be messing around with the 0-day options. So we don't want to try to read that data. It'd be trying to, like, looking at a bunch of spaghetti, trying to figure out what the message is in the noodles. So this is what it's all about today, guys. CPI and job numbers. And it's a double whammy, right? Because these are the two parts of the Fed's dual mandate: inflation and employment. I'll leave you guys with this. I've got a degree in psychology, working on my doctorate. And one of the things that we've seen throughout history is that when things are going really bad, men don't want the leadership role anymore, right? You can't, when it's time to elect a new leader, men won't step up to the plate because it's a broken house, it's a bad system. Everybody knows that it's about to go down, and they don't want to be the one holding the hot potato. And throughout history, that's when we've seen the glass ceiling break, and we've seen women rise to power and minorities rise to power in those situations and have proven to do an excellent job. But they would have never have gotten the shot at it if there wasn't a lack of someone willing to take the place, right? Because it's a male dominated environment. BP elected their first female CEO. The other person stepped down after less than 2 years in place. Things are really bad. They couldn't get a man to step in to this bad, broken system. And there's another example. And this isn't me saying this, right? This is what we learned in college. You can look it up. It's there. I can send you all the links for it. But this is a good thing for BP, not a bad thing for BP, because usually what happens is the woman gets in and things get turned around. So that won't be a one-day wonder. It's going to take time to turn BP around, but they got new leadership, and it's just one of them interesting human quirks, right? It's the way that it is. Look back at some of the biggest turnaround stories that you've ever come across, and you would see the same situation play out again and again. They couldn't find a man to take over the company to run the CEO leadership role because nobody wanted it. They didn't want to tarnish their pristine record that got them to the point where they were even offered the job. So someone stepped in to do it who wasn't a man or who wasn't a white man and got things turned around and fixed. Keep your eye on BP over the next couple of years. Probably see some interesting changes. That's what I got for you guys. Be careful, be safe. Watch the clock. We got data coming in today that very likely will change the course of the rest of the day. I'll see y'all tomorrow.